Something is happening in the shadows of global finance right now that almost nobody is talking about. Central banks around the world are buying gold at a pace we haven't seen in over half a century. Not just buying it, but hoarding it, stockpiling it, like they know something catastrophic is coming. And the most unsettling part? They're doing it quietly, methodically, and with an urgency that should make every single person watching this video stop and ask why. Why now? Why gold? And what do they know that we don't? If you're someone who cares about protecting your wealth, understanding where the economy is actually heading, and not just blindly trusting what the media tells you, then you're in the right place. This is the Wealth Continuum, where we break down the financial signals that matter, the ones hiding in plain sight. If this is your first time here, go ahead and subscribe, because we're going to connect dots today that most channels won't even touch. And I want to know, where are you watching this from? Drop your city or country in the comments. It's wild to see how global this audience is, and how many of us are paying attention to the same warning signs. Let's get into this. In the last 2 years alone, central banks have purchased over 2,000 metric tons of gold. To put that in perspective, that's more than the annual production of every gold mine in South America combined. The People's Bank of China has been on an absolute buying spree, adding to their reserves month after month without pause. Turkey, India, Poland, Singapore, they're all doing the same thing. Even countries you wouldn't expect are suddenly very interested in physical gold. Here's the part that changes everything. The Federal Reserve, the central bank of the United States, the institution that controls the world's reserve currency, isn't buying more gold. They're sitting on the same stockpile they've had for decades. Now that might sound insignificant, but when you understand what's actually happening, it becomes one of the most important financial signals of our time. Gold has always been the ultimate hedge against uncertainty. It's not a stock. It's not a bond. It doesn't have a quarterly earnings report. It doesn't depend on a CEO or a board of directors. Gold is simply a store of value that has survived every empire, every currency collapse, every financial crisis in human history. When central banks start hoarding it, they're not doing it because they think the price is going up. They're doing it because they're losing faith in the system they themselves created. Think about that for a second. The very institutions that print money, that set interest rates, that tell us inflation is transitory and everything is under control, those same institutions are quietly preparing for something else. They're diversifying away from the dollar. They're reducing their exposure to U.S. treasuries. They're moving into hard assets. And gold is at the top of that list. This isn't conspiracy theory. This is publicly available data from the World Gold Council, from IMF reports, from the central banks themselves. They're just not making a big deal about it, and most people aren't paying attention. Now, some people will say this is normal central bank behavior, just routine reserve management. It's not. This chart alone explains it. If you look at annual central bank gold purchases going back 50 years, there's a massive spike starting in 2022 that dwarfs everything, except the period right before the collapse of Bretton Woods in the early 70s. We're talking about purchases that have tripled compared to the previous decade. That's not routine diversification. That's panic buying disguised as policy. And here's what makes this even more significant. Individual investors are starting to follow the same playbook. Bullion dealers across the United States are reporting unprecedented demand for physical gold and silver. We're not talking about paper ETFs or mining stocks. We're talking about actual bars and coins that people can hold in their hands. Some of the largest bullion dealers in the country have reported waiting lists for popular items like American Gold Eagles and Canadian Maple Leafs. Premiums, the amount you pay above the spot price of gold, have jumped significantly because demand is outstripping supply at the retail level. Let's talk about why this is happening right now. We've been living through one of the most aggressive monetary experiments in history. Since the financial crisis of 2008, central banks have printed trillions of dollars out of thin air. Quantitative easing, zero interest rates, negative interest rates in some countries. The money supply has exploded. And for a while, it seemed like it worked. Stock markets went up. Real estate went up. People felt wealthier, at least on paper. But there's a cost to all of that, and we're starting to see it now. Inflation isn't just a number on a government report. It's the groceries that cost 30% more than they did 3 years ago. It's the rent that keeps climbing. It's the erosion of purchasing power that hits the middle class the hardest. Central banks know this. They know that when you create money faster than you create value, eventually the currency loses credibility. And when a currency starts losing credibility, people look for alternatives. For thousands of years, that alternative has been gold. It's why every major empire in history backed their currency with it. It's why the US dollar itself was backed by gold until 1971. And it's why, even today, in an age of digital payments and cryptocurrencies, central banks still hold over 35,000 metric tons of the stuff. But here's where it gets really interesting. The countries buying the most gold right now are the same countries that have been trying to move away from dollar dominance. China has been very open about wanting to internationalize the yuan. Russia has been reducing its dollar reserves for years and has publicly called the dollar a weapon of economic coercion. Even U.S. allies like France and Germany have quietly repatriated gold from New York back to their own vaults. These aren't random actions. This is a coordinated shift, a slow-motion decoupling from a system that has been in place since World War II. The Bretton Woods Agreement made the U.S. dollar the world's reserve currency. Every country needed dollars to trade oil, to buy commodities, to settle international debts. That gave the United States an enormous advantage. We could run deficits that other countries couldn't. We could print money and export inflation. We could sanction nations and freeze assets because the global financial system ran through our banks. But that power is not guaranteed forever, and right now, we're watching the early stages of what could be the end of dollar hegemony. You might be thinking, okay, but how does gold fit into this? Here's what nobody's telling you. Gold doesn't care about sanctions. It doesn't require a SWIFT system. It doesn't depend on trust in a government or a central bank. If you're a country that wants to trade outside the dollar system, gold is the ultimate neutral settlement asset. That's exactly what we're seeing with bilateral trade agreements between China and Russia, between India and the UAE. They're experimenting with gold-backed settlement systems, with currency swaps that bypass the dollar entirely. It's not mainstream yet, but the infrastructure is being built right now. Now, let's bring this back home. What does this mean for the average American, for someone watching this video who's just trying to protect their savings and plan for the future? It means the rules are changing. For decades, the strategy was simple. Keep your money in the bank, maybe buy some stocks, trust that the dollar would hold its value. And for a long time, that worked. But we're entering a period where that assumption might not hold. When central banks don't trust each other's currencies, when they're buying gold instead of bonds, that's a signal. It's a signal that the system is fragile. And smart investors are catching on. There's been a noticeable shift in how people are approaching precious metals. It's not just the traditional gold bugs anymore. You're seeing financial advisors who previously dismissed gold now recommending a 5 to 10% allocation. You're seeing younger investors, people in their 30s and 40s, buying their first gold coins. You're seeing families setting up storage for physical bullion because they don't trust that their wealth in the stock market or in their bank account is truly safe. Here's the part that should terrify you. If the dollar loses its reserve currency status, even partially, the consequences for the U.S. economy would be staggering. Right now, we can borrow at incredibly low rates because the world needs dollars. We can run trillion-dollar deficits because other countries buy our debt. But if that demand drops, if countries start settling trade in yuan or euros or even gold, interest rates would spike. The cost of servicing our national debt would explode. Inflation could spiral out of control. We've seen the story play out in other countries, Argentina, Turkey, Venezuela. It's not pretty. And the idea that it can't happen here is exactly the kind of complacency that leads to disaster. Let me give you a specific example that really drives this home. In 2022, Russia was hit with the most severe financial sanctions in modern history. Hundreds of billions of dollars in reserves were frozen overnight. Russian banks were cut off from SWIFT. It was economic warfare on a scale we'd never seen before. But here's what most people missed. Russia didn't collapse. Why? Because a significant portion of their reserves were in gold, physical gold held in Moscow, not New York or London. They couldn't freeze that. They couldn't sanction that. And that lesson was not lost on the rest of the world. Every central bank on the planet saw what happened and asked themselves, could that happen to us? And the answer for many of them was, we need to reduce our vulnerability. We need more gold. We need assets that can't be weaponized against us. This wasn't theoretical anymore. This was a real-world demonstration of why diversification away from dollar-based assets matters. And it's not just central banks learning this lesson. Wealthy investors, family offices, and even pension funds are quietly increasing their bullion allocations. Some are going beyond just buying gold ETFs. They're buying physical bars, setting up private vaults, and in some cases, even taking delivery of significant quantities. There are reports of high net worth individuals purchasing hundreds of ounces at a time, not for speculation, but for long-term wealth preservation. This is old money strategy coming back into fashion because new money strategies, the ones based purely on paper assets and digital accounts, suddenly feel a lot more fragile than they did a few years ago. China has been especially aggressive. Official numbers say they've added around 400 tons over the last 2 years, but many analysts believe the real number is much higher because China has a history of underreporting their gold reserves. Why would they do that? Because if the world knew how much gold they actually had, it would signal their intentions too clearly. It would reveal that they're preparing for a post-dollar world, and they're not ready to show that hand yet. But the buying is real. The vaults are filling up, and every ounce they add is one less ounce tied to the Western financial system. Here's where the logic breaks down completely. Central banks aren't just buying gold from the open market, they're also mining it domestically and keeping it within their borders. China is the world's largest gold producer, and almost none of it leaves the country. Russia is number 2, same story. They're not exporting it, they're stockpiling it. Meanwhile, Western countries, including the United States, have seen domestic gold production plateau or decline. We're not prioritizing it, we're not securing it, and that's a strategic mistake that could cost us dearly. You have to ask yourself, if gold is just a barbarous relic, if it's just a shiny metal with no real purpose in a modern economy, then why are the smartest financial minds in the world accumulating it at record levels? The answer is simple. They don't believe their own propaganda. Publicly, central banks talk about confidence in fiat currency, about the strength of the dollar, about inflation being under control. But privately, their actions tell a very different story. They're hedging, they're preparing, they're moving assets into something that can't be printed, that can't be debased, that can't be controlled by any single government. And this isn't just about countries. Everyday people are starting to notice too. Sales of physical gold and silver coins are up significantly. Demand for allocated storage, where you actually own specific bars with serial numbers, is surging. People want to hold real assets, not just numbers on a screen. Because deep down, there's a growing sense that the system is running on borrowed time, that the debt can't keep growing forever, that the money printing can't continue without serious consequences. For investors specifically, there's an important distinction to understand. There's a massive difference between owning shares in a gold ETF and owning physical bullion. An ETF is convenient, sure. You can buy and sell with a click, but you don't actually own gold. You own a claim on gold that the fund holds, or in some cases, a claim on derivatives of gold. If there's ever a real financial crisis, if the system actually breaks down, good luck trying to redeem those shares for actual metal. The fund might suspend redemptions. The counterparties might default. The whole paper gold system could unravel. Physical bullion is different. When you buy a gold coin or a bar from a reputable dealer, take delivery and store it securely. That's yours. No counterparty risk, no redemption issues, no reliance on the financial system functioning properly. That's why serious investors, the ones who really understand what's at stake, are willing to pay the premium, deal with the logistics, and hold physical metal. It's insurance, and like any good insurance, you hope you never need it, but you're glad you have it if things go wrong. Now, some of you might be wondering, what about Bitcoin? Isn't that supposed to be digital gold? And look, I'm not here to bash Bitcoin. It has its place. It's an interesting experiment in decentralized currency, but let's be very clear. Central banks are not buying Bitcoin. They're buying gold. Why? Because gold has 5,000 years of history. It's recognized universally across every culture, every nation, every political system. It's tangible. You can hold it, you can store it. It doesn't depend on the internet or electricity or a network of miners. In a real crisis, in a world where financial systems are breaking down, gold is the asset that has always survived. Bitcoin might survive too, but we don't have thousands of years of evidence to prove it. Now here's what changes the entire game. This trend is accelerating, not slowing down. It's not a blip. It's not a temporary phenomenon. Every quarter, we see new reports of record central bank gold purchases. Every month, another country announces they're increasing reserves or repatriating gold from foreign vaults. This is a mega trend, and mega trends don't reverse quickly. Once institutions of this size start moving in a direction, it takes years, sometimes decades, for that momentum to shift. And right now, the momentum is clearly pointing toward gold and away from pure dollar reliance. There's another angle to this that most people completely overlook. The gold market itself is relatively small compared to other asset markets. The entire above-ground gold supply, everything that's ever been mined in human history, is worth around $15 trillion at current prices. That sounds like a lot until you compare it to global stock markets at over 100 trillion, or global real estate at over 300 trillion, or global debt at over 300 trillion. Gold is tiny by comparison, which means when central banks start buying aggressively, it doesn't take much to move the market. And when the market moves, it sends a signal to everyone else that something is shifting. The other thing people don't realize is that most gold trading is paper gold, not physical gold. Futures contracts, ETFs, unallocated accounts, it's all claims on gold that may or may not actually exist in a vault somewhere. But central banks aren't buying paper. They're buying physical bars. They're taking delivery. They're storing it in their own vaults. That's a completely different level of commitment. That's saying we don't trust the system enough to just hold a contract. We want the real thing. And increasingly, private investors are doing the same. Bullion dealers report that their most savvy customers, the ones who've been in the market for years, are specifically asking for delivery. They're not interested in certificates or pool accounts. They want serial numbered bars. They want coins they can inspect and verify. Some are even having assays done to confirm purity. This level of diligence wasn't common 5 years ago. Now it's becoming standard practice for anyone serious about precious metals investing. So what should you do with this information? I'm not going to sit here and tell you to go sell everything and buy gold bars tomorrow. That's not the point of this channel. The point is to make you think, to make you aware of what's happening beneath the surface, to give you information that the mainstream financial media isn't covering. But I will say this, if the people who control the money, the people who have access to information and intelligence that we don't, if they're buying gold at record levels, maybe it's worth considering what that means for your own financial strategy. Diversification isn't just about having different stocks in your portfolio anymore. It's not just about a mix of bonds and real estate. It's about having exposure to assets that don't depend on government promises, that don't rely on central bank credibility, that exist outside the traditional financial system. Gold is one of those assets. Silver too, for that matter, though that's a conversation for another video. The point is, physical precious metals, actual bullion that you own and control, represents a form of wealth that can't be inflated away, frozen by governments, or erased by financial system failures. For those of you seriously considering adding bullion to your portfolio, here's what you need to know. Start with reputable dealers, do your research, check reviews, verify that they're authorized dealers for major mints, understand the difference between coins and bars. Coins typically carry higher premiums but are easier to sell and more recognizable. Bars have lower premiums but might be harder to liquidate in smaller quantities. Think about storage. Some people keep small amounts at home in a safe. Others use allocated storage at professional vaults. There's no one-size-fits-all answer. It depends on your situation, your risk tolerance, and how much you're allocating. The reality is that we're living through a historic transition period. The financial order that has defined the last 80 years, the post-World War II dollar-dominated system, is being challenged, not loudly, not with dramatic announcements or international summits, but quietly, methodically, through thousands of small decisions made by central banks, finance ministers, and heads of state around the world. They're building alternative systems. They're reducing dependencies. They're preparing for a world that looks very different from the one we've known. And gold sits at the center of that preparation. It's the one asset that everyone agrees has value, regardless of politics, regardless of ideology, regardless of which currency you prefer or which government you trust. It's the ultimate fallback, the ultimate neutral ground. And the fact that it's being accumulated at this pace, at this moment in history, by both massive institutions and individual investors who are paying attention, tells you everything you need to know about where we actually are in this economic cycle. The central banks see something, they know something, whether it's the unsustainable debt levels, the fragility of the banking system, the geopolitical realignment happening in real time, or some combination of all of these factors. They're acting. They're not waiting. They're not hoping things get better. They're taking concrete steps to protect their nation's wealth and reduce their exposure to systemic risk. And they're doing it with gold. The investors who understand what's happening are doing the same thing, just on a smaller scale. They're converting a portion of their paper wealth into physical bullion. They're taking control of their own financial security, instead of leaving it entirely in the hands of institutions that may or may not have their best interests at heart. So here's what I want you to think about. Here's the question that should be keeping you up at night. If the institutions that run the global financial system, the ones with the power to print money and set policy and move markets, if they don't trust that system enough to keep all their reserves in it, why should you? What do they see that makes gold worth accumulating at levels we haven't witnessed in 50 years? And more importantly, if they're right, if we are heading toward some kind of monetary reset or currency crisis or financial restructuring, where does that leave you and your wealth? Drop your thoughts in the comments. Tell me if you think this is just central banks being overly cautious, or if you see this as a genuine warning sign of what's coming. Tell me if you're already holding physical bullion, or if this is making you consider it for the first time. Because the more people who understand what's actually happening, the better chance we all have of navigating whatever comes next. The game is changing. The institutions know it. Smart investors are figuring it out. The only question is whether you'll see it in time.